The objective of Plan Your Personal Finance. In today's topic, we will try to understand what is the objective of Plan Your Personal Finance. Hello, everyone, this is Gustav Biswas, and you are listening to Plan Your Finance with Gustav. Here I will discuss based on my around 15 years of professional experience and studies from different sources. You might get similarity with some content. My object is to give you the right content that is relevant for you. I have chosen this format to give you maximum content in minimum time. Listen to this podcast till the end. You might get some useful information which could be important to understand the value of Plan Your Personal Finance. Now let's start. If you ask any person, why are you manage your personal finance? The traditional answer is, to manage my expenses within my earning and to put aside a little bit for a rainy day. And for some people, planning personal finance means only investment into tax savings investment because of tax exemptions or investment in bank fixed deposits. This leads to a situation where people invest money without really understanding the logic or the rationale behind the investments made. The right planning of your finance starts from some small questions like 1. Do you have enough money to survive for the next 3 months, if you do not have income for next? 2. Do you have enough money for your child's educations? 3. Do you have enough money for post-retirement lifetime pensions? Etc. Planning your personal finance is nothing but set up your personal priorities, helping their personal and financial objectives or goals. But again, it should be very much customized, because every individual is different, their priorities are different, their personal circumstances are different, their goals, attitude, and needs, social circumstances, dependency, risk appetite, etc. Everything is totally different. Now let's discuss some common financial objectives or priorities or goals for which people set to plan their finances. 1. Emergency funding. An emergency fund may be needed to meet unexpected expenses to provide a financial cushion against such personal problems as unintended unemployment. The size of the emergency fund varies greatly and depends on such factors as family income, numbers of income earners, the stability of employment, assets, debts, insurance deductions, uncovered health, family general attitude towards risks. Depending on family income and expenditure, you can create for 3 to 6 months. Your investment should be in the product which is low risk and highly liquid in nature. Two. Capital accumulation. Some people have some objective to increase wealth in their lifetime so that they can transfer to their next generation. Again, some people want to accumulate wealth to set up their businesses. There might be different reasons for different people to accumulate wealth. But again, risk profiling and time horizons play one important factor. Three. Education funding. The cost of education is increasing like anything. For one set of people, it is becoming business, but for other sets of people, they need to spend their hard-earned money and future livelihood for their and their child's educations. And again, some places you may find people make entry barriers so strong that without certain so-called certification you or your child cannot enter and perform peacefully. No matter how much anyone may know or studied from outside, and again after a certain point of time may be deciding factor of someone's career growth could be the branded piece of pepper. But it may change going forward. So, for a safer side as a parent, you need to plan to support your loved one to achieve his or her ambition by using his/her true potential. Four. Retirement funding. It is an important objective for each and every people. Each type of profession has their own life cycle. Like government employees can work for 60 years, some sectors people cannot work for more than 55 years. Some professions like sports or acting people may have a very small working life, etc. Say for example, let's take one scenario where people start their job at the age of 25 years. He or she worked till 55 years and his/her life expectancy is still 85 years. 55 to 25 equals 30 years. Whatever you earned and after expenses, you saved by that you need to survive next 85 to 55 equals that means 30 years. So, you understood how important it is. For each and every person, it'll require customized solution based on their different parameters like risk profile, cash flow, income, and expenses ratio, etc. Five. Lifestyle improvement. I remember some people when they came to me, he or she does not have a clue how to plan for a pension. So, I started guiding them like, after retirement your home loan ME might not be there, your child education expenses might not be there. For you and your wife's food, medical expenses, here and there some tour or some gifting, how much do you think you need and that should is on today's value? Average people in Bangalore save between 50,000 to 1 lakh. And next over the period, I have constricted their portfolio. Maybe again after 3 to 4 years when we do a reassessment of their goals or objectives. A lot of people came back and say why not we increase pension target bit more. By this time, they are confident about their portfolio. They participated in end of the process of portfolio construction along with me. Now their thought process is very much clear towards their objective and cash flow. Special need funding. You can plan for your special needs funding like nice domestic or overseas vacation with your family. Say for example you need to pay a lump sum money for something like you want to purchase your vehicle or you want to purchase home appliances. You purchase an expensive gift, something for your wife, etc. Seven. Protection against personal risk. Some people like to protect themselves and their families against the risk they face every day of their life. 8. Premature death. A major goal of most people is to protect their family from the financial consequences of their deaths. Some people are also concerned with the impact of their deaths on their business or their estate's liquidity. Let's understand various financial losses that may result in death. 1. Loss of the deceased's future earning power. 2. Costs and other obligation arising at death. 3. Increased expenses for the family. 4. Loss of tax advantages. 5. Loss of business value because of an owner's or key person's death. 6. Estate shrinkage at death. 9. Disability income losses. Loss of earned income due to the disability of the income earner is referred to as disability income exposure. Such a disability exposure, particularly total and permanent disability, serious risk faced by almost everyone. 10. Medical care expenses. It is important for everyone to protect against medical expenses. There are 3 types of medical expenses. 1. Normal or budgetable expenses. 2. Larger than normal expenses. 3. Catastrophic medical expenses. 11. Long-term care expenses. These types of expenses are typically happen to maintain persons when they are unable to perform at least several or normal activities of daily living. These expenses are associated with custodial care for persons who is no longer able to care for themselves. Custodian care can be taken a variety of forms, like skilled nursing home care, intermediate institutional care, adult daycare, and home health care, etc. 12. Unemployment. Nowadays most of the people work in private companies, and there is no guarantee of a lifelong stable job. When there is an economic downturn, the unemployment rate will inevitably increase. Planning enables you to use your money wisely and prepare a proper cash flow which would be enough to spend during this zero income period. (13) Reduction of the tax burden. Some people want to plan their finance to reduce their tax burden. Like people invest in a product that has 80C benefit, 80D benefit, 1010D benefits, etc. 14. Estate planning. The objective of estate planning is to minimize the amount of income tax payable by the heirs. It is necessary and ideal to have in place a plan, or will, that will aid the distribution of one's assets, no matter how much or how little. When a person dies, who leaves behind a will is said to die testate, and this gives rise to testamentary succession. A will is necessary to ensure that the assets, estate, are distributed according to the deceased's desire. Disclaimer: here are some of the places I have used some example which may or may not be relevant for someone. I have tried to give some extreme scenarios to make you understand the seriousness of money management. From my experience, I can say everyone is different and their financial structure and objective towards money management is totally different. It is only a knowledge sharing effort from my side. Before application, I will recommend you talk to your financial advisor.